Welcome back to the Kelowna Real Estate Podcast. I'm your mortgage broker host, Taylor Atkinson.
I'm your real estate agent host, Matt Glenn. What's happening today, Taylor?
I don't know, man. Is it your camera? Or are you just really suntanned? What's going on over there?
Yeah. Got back from Hawaii. Kauai was exactly where we were, and it was awesome. The flights were an interesting story, to say the least. Traveling with our 19-month-old son. Man, get into the Kelowna airport. It's like the busiest the airport has ever been. I've been to that airport a lot of times, and I was in the airport, and it was like shoulder to shoulder, no seats. I know a few people in there, so I'm talking. My son's running around. Just after nap time, it's 3 o'clock or so. Julian's just having a great time running around, trips, falls, hits his face basically right on the ground, has a red mark across his forehead, starts screaming, does not stop screaming through the airport, the whole first flight, the time in Vancouver on our layover, on to the flight to Hawaii. Pretty much the whole flight to Hawaii screamed, and like I'm walking up and down the aisle with him, trying to calm him down, and like, oh my God, it was stressful. And like just waving to all the different people in the plane, because when you walk down the aisle like 13,000 times in the one flight, you're going to see every face. And
yeah,
the trip was awesome. The plane rides were not the greatest. And you know, the plane ride went south is when it's over. And while everyone's exiting, almost every passenger is going to Becca and I and saying, "You guys are great parents. You're doing great. You're doing great. You guys are great parents."
Just hang in there, man.
You know, in that moment, you are not, in fact, doing a great job. Because like, it's like nobody says that to a kid that's just chill, sitting there, not saying anything during the flight. You only say that to the psycho once.
Yeah, but you know what? As a parent, where like the one time your kid is actually acting, decent, well behaved, and then you see another parent, you're kind of like smirking to yourself, like, yes, this is the time of my glory,
Yeah.
But everyone's gonna take their turn.
He wasn't even like misbehaving. He was just like, he just did not settle. It's not like he was doing crazy shit. He was just screaming. He just was uncomfortable. On the way home, it was a red-eye flight, so he slept the whole time. It was after bedtime and stuff like that, so he went down. So the ride home was way smoother than the ride there, but man, we added some stories to the flight attendants' repertoire going forward, to tell you that. So
yeah,
an awesome trip. It's fantastic.
It's good to have you back. It's starting to get cold around here, and
nothing like trading in the sand for a little bit of snow on the ground as you land. So
yeah, exactly. You go to any luau's out there?
We did not. We did see a lot of turtles, which was awesome. Seals, pool times, beach time. We did not do any luau's. We just chilled. It was very awesome. Yeah.
Good.
Yeah.
Well, yeah, today's guest we had on was awesome, and I've chatted to him a few times, kind of off air. Justin Smith, president of Hawkeye Wealth, super intelligent guy.
Super funny.
Yeah.
When I was reading his bio, I was not expecting the level of sense of humor. He is a funny dude.
Yeah, the way the show started, I was crying laughing. He's a very authentic, genuine guy, and he tells you what he's passionate about. Absolutely, like just a great show, really detail orientated, and seems like a wealth of knowledge that he's willing to share. So we're really happy to have him on.
Yeah, it was a great one.
Okay, and a big takeaway from today, Justin Smith highlights that they have reviewed 200 mortgage funds in Canada. So private lenders take investors' money and then redeploy it elsewhere. So they've reviewed 200. They've picked out their top two, and they've actually written a white paper on this. They have a landing page. We'll put that in the show notes, so you can just click on that and go to the landing page. Or if you guys want, you can just throw in the comments Hawkeye, and we'll just send you the PDF directly. Obviously, we have access to that. It's a really good read.
I love the call to action. I love it.
Thank you.
Placed.
Thank you.
That was fantastic.
Hit us up in some comments, get some interactions. Yeah, we're terrible with call to action.
So the white paper is literally a PDF that just has all the goods on it.
Yeah. So he throws it out why you should invest in one and not the other, and why on the surface level, some maybe look the same but are not the same. And he's talking about, loan to value and properties, location, position of the mortgage, either first position, second, So he just dives into it all. But basically, he's been managing a large portfolio. And since there hasn't been a lot of activity in the equity deals, meaning like investing in startups and new builds and, large towers, he's kind of repositioned some of that money into some mortgage funds. So, if he's back in these, it's probably a pretty good product to look at if you want to throw some investments around with them.
Also a great episode if you want to learn a little bit about smoking brisket, right?
Yeah, absolutely. I want to get into smoking now.
Yeah, you have happy neighbors when your whole neighborhood smells delicious at 3 a.m.
Yeah. Yeah, it's a process. You got to be committed to that, man.
This is a fun episode, guys. Enjoy it. And this episode, like every episode, is sponsored by Century 21 Assurance Realty, fastest growing brokerage in interior BC. I actually don't know if that's true, but it feels like we are. We are growing. We're expanding. Got to be the fastest expanding brokerage in BC because we're everywhere now. We're in Vernon, Kamloops, Kootenays, Salmon Arm. We're everywhere in the interior. If you need a Century 21 agent in interior BC, we're the people you go to.
Right on. Hey, like and subscribe, share the show. Just another plug for a call to action. But yeah, all right, guys, enjoy the show. Okay, welcome to the show, Justin Smith. Thanks for joining us today.
Thanks for having me.
Yeah, so we like to start our show just what's your perfect Friday look like in terms of work, productivity, what's kind of your normal routine, and then leading into the weekend.
Yeah, my Fridays look a lot like, I don't know if there's anything really different about them. I've basically got two questions I ask myself every morning. My one job is to go talk to people. That's what I do every day. And I talk to literally one of two groups of people. It's either I'm talking to people that have investment opportunities. These would be your developers, your value add operators, people that do mortgage investments, these types of folks. Or B, I want to go and I want to talk to people that have money to invest. And depending on which stage of the cycle we're on, I decide which one of those two things I'm going to spend more time on and have the company focus on. But if I want to talk about a perfect day, I get pitched a new great deal. Maybe I'd get some good news on a deal that we're in, maybe an exit, a refinance, some piece of good news. Have a few great conversations with investors who are looking to place money, ideally very wealthy investors, but beggars can't be choosers. I love talking to our investors. Maybe hop on my exercise bike for half hour or so, get my brain going again. A little kettlebell workout. I just do that in the office. That's a pretty good day. And then if I'm going to go and have some fun at the end of that day, I might go out and smoke some meat. I'm an amateur barbecue guy.
Nice.
No offense to the vegetarians listening today. Yeah, I actually said we have meetings every morning, and I had one of my colleagues ask me what I did over the weekend, and I said I smoked some meat, and he thought I said smoked some weed. And yeah, no, if any of the listeners are here today, I'm not smoking weed over here, but do enjoy a good brisket.
Oh my God.
Well, I'm looking forward to trying that brisket then.
So when you say you spent the weekend, has brisket on for like 20 hours?
Yeah. When I say I spent the weekend, I actually spent the weekend. Yeah. Well, a good brisket, because you're cooking it at a low temperature and it's a big piece of meat, right? So
yeah,
that thing's on there usually anywhere on the barbecue itself for 10 to sort of 14 hours.
Wow.
And if you want to have it done at the right time, you're doing this through the night. So yeah, you're cooking it for the next day. And then after it's off the barbecue, you've got to rest it anywhere from, let's say 1-2 hours to maybe 5-6 hours. You wrap it up like a baby in a towel and you stick it in a cooler. And who wants to talk about real estate anyways, guys?
I gotta ask.
The greatest tangent of all time.
Yeah. Do you enjoy the taste of the meat or the process of cooking it better?
It's really both. Let's say I do a brisket. It's a large piece of meat, and it's me, my wife, and my son. I've just cooked like a 15-pound piece of meat. And I may or may not have invited anybody over. I'm craving it when I make it, and I go hard, and then I don't want to eat it again for like another 3 months.
I've been there too.
Yeah, I've repeated this process over the last probably 3 or 4 years quarterly.
I love it. Hey, you got to be passionate about something outside of real estate. Eh? We should start a cooking show. This is more interesting to me.
Yeah. Probably a great way to seal some deals here, get some investors on board.
Yeah.
Listen, you sit here and we're going to be here for about 15 hours.
Yeah, exactly.
Yeah, you could golf together, or you can just go smoke a brisket together and solve all the world's problems.
Yeah.
Okay, well, maybe we can talk about like real quick elevator pitch of kind of like Hawkeye Wealth. What is Hawkeye Wealth? When did you kind of start it and why did you start it?
Yeah, so we're a private real estate investment firm and started up in 2017. I was in the real estate business prior to that. Actually lived in Kelowna for a number of years, moved out to Alberta, worked in the banking industry for a few years, came to the Lower Mainland to do my master's in business. And then shortly after that, we started working with a developer who was developing condos and townhomes and single family houses specifically geared towards investors in the Lower Mainland, but in Northeast BC, Fort St. John and Dawson Creek area. So that's where I started my career in real estate. This would have been 2011, 2012. That same developer that was involved in Northeast BC partnered up with someone and started getting involved in multifamily value add projects down in the southern United States. So think Phoenix, Dallas, Houston, the Sun Belt market. And so I came along for that ride and started raising capital for deals down there. And that was my first exposure to really the private real estate investment space. These were all structured as limited partnerships. And these are where I held some of my first investments as well. In addition to holding a condo, a townhome, and a single family house in Dawson Creek and Fort St. John still. I like to joke with my clients that I managed to find the only markets in BC that haven't appreciated over the last decade. Yeah. So that really got me going. That was a very great wave that we rode in the southern US. You were buying properties in Phoenix for $30, $40, $50,000 a unit, and the rents really started to ratchet up. Of course, the values came up as the cap rates decreased. So we rode that wave. 2017, 2018, the regulatory landscape was shifting, and I was no longer going to be able to legally raise capital without either joining a registered investment firm or starting my own. And when I started looking around out there for a firm to partner with, because quite frankly, that was my preference, was to join somebody else's shop. There's a lot of compliance in our business. We have financial audits annually, which are mandatory in our business, and we're regulated by the BC Securities Commission. And there's a lot of compliance and regulatory oversight, anti-money laundering as well. Those things are very important, though that's not the thing I wanted to spend my life doing as much. So my preference was to join another shop. But when we started getting out there and looking, I just couldn't find the right group to partner with. Either A, I wasn't on board with the types of deals that they were bringing to the table to the investors I'd built relationships with thus far. And B, there's a certain level of service that I expect our clients to receive. And when I looked at it, I just ultimately decided that I want control over that process. So because of those two reasons, control over the deals, more control over the client experience, Hawkeye, that process started in 2017. Since that time, we've invested in just over 45 equity deals. These would be more value add projects, as well as development deals across North America, but particularly focused on the West, both in Canada and the US. And on the other side, we've also invested in quite a bit of debt fund offerings. So in kind of 2018, 19, we really pulled back in 2020 when COVID hit. But then 2021, again, we did a lot of development deals and equity-based deals. In 2019, we were already getting a little bit concerned about those returns and how likely they were to materialize. So we started looking at the debt funds at that time, early 2019. It took us about 18 months to find the first fund that we were really excited to partner with, but we did that in the summer of 2020. And since that time, the majority of our equity raised, particularly since 2021, has been more into the debt funds like mortgage mix. A lot of people know them as more than the equity deals. So I'd say we're lots of equity. 2022 hits and we've really pulled back, whereas we traditionally invest in maybe 10, 11, 12, 13 projects a year. 2022, we invested in 2 projects. 2023, another 2 projects. 2024, year to date, 3 projects. So we'll see what 2024 holds, but gives you a little bit of a background.
Yeah. So can we kind of break this down into 2 segments then? Maybe the investing in private mortgages, and then part 2 would be like equity deals. So in terms of private mortgages, there's a lot of lenders throughout Canada that work in this space. You don't kind of have to say particulars or names or anything, but you've refined it down to a very short list. How did you do that? What would you caution people about for investing in some of these lenders? Because, most people can access these and invest in their funds. And for the listener who maybe doesn't know, a lot of these private lenders are like a second position mortgage. So they'll go behind a, conventional lender and, consolidate debt or add some extra, liquidity for that client. And then some of the lenders do like much larger projects. But yeah, can you just kind of walk us through like how you figured out pros and cons, and what landed you with what lenders?
Yeah. You might need to remind me on what a couple of those questions were, but really starting out with how we got to partner with the funds that we did. And for us, our primary goal was to find funds that were defensively positioned. That was by far the thing that was most important to us. We were getting involved in this because we saw a little bit of turbulence in the market in 2019. Actually, people forget this, but the interest rates for a little while were coming up at that time before COVID hit, and then they immediately nosedived again. So we got a little bit of a preview as to what higher interest rates might do to equity deals, right? And so we were thinking, well, we'd better have a more defensively positioned alternative for our client and for Hawkeye too, right? Because we don't want to be sitting down doing nothing for long periods of time. So for us, what did defensive mean? It meant we wanted funds that had a lower average loan to value. Our criteria was under 60% loan to value. So, if you've got $1 million property, it's only a $600,000 loan, maybe a $650,000 loan. We wanted primarily first mortgages. Our first fund partner currently has about 99% first mortgages in the portfolio. We wanted primarily existing residential property versus investing in mortgages that were loaned on land or construction financing. The reason for that is they're generally much more liquid if the lender has to sell. So if you're lending on a condo in the lower mainland or Kelowna, that's much more easy to sell than a piece of land. I don't know if you guys are in the land business at all, but I imagine that they're not moving a lot of properties and
They are not. I know this from personal experience. Yeah, it is a
confirmed.
tough sell. Yeah,
Yeah.
yeah.
So we really wanted some underlying liquidity in that. That was important to us. And then we wanted a fund that was over 100 million in size. So you talk about what criteria we had, Taylor. There's a lot of funds in Canada that are sort of this 10, 20, 30 million. They might have access to some okay mortgages and they might manage those investments well. For us, a concern was they're usually one or two person shops. If something happens to that person, they get sick, they get hit by a bus, who knows? There's just not the scale there and the systems in place to give us that comfort. And then the second part of that is the private mortgage business. These deals primarily come from mortgage brokers. I don't know if you guys know any of those. So,
Not any good ones, anyways.
yeah, there we go.
Yeah.
You've probably done a private loan or two in your day, right? And so these come from you. And if you go to a fund and that fund doesn't have the money to fund whatever deal you're bringing to them, and they say, sorry, we don't have the money, enough times, you just stop bringing your deals to that fund. So you need a certain scale where you're able to say yes to the right deals when the mortgages bring them to you. So for all those reasons, a fund size to us was very important. So we ended up coming through about 75 different funds. You apply those criteria, and that probably brings you down to maybe 20-ish funds that we looked at in a little bit more detail. You start combing through offering memorandums and limited partnership agreements and meeting teams, and sometimes there's not a fit on our end, sometimes there's not a fit on their end, they didn't need any capital perhaps. And so ultimately what I thought was going to be a 4-month process to find the right fit ended up being about an 18-month process. So they're certainly not all created equal. And you'd asked, what things to maybe look out for. Well, one thing we've noticed in the business is investors are very good at knowing what the return of one fund is versus the return of another fund is. If they're looking at all, they might know what the average loan to value of one fund versus another is. They might know what the percentage of first mortgages is in one fund versus another. But once you get deeper than that, there's just too many variables that aren't being considered. Asset type, asset location, quality of the management, skin in the game of the management. I'm not sure if it's a sophistication problem or just not the will to go and do the due diligence. We find that investors don't do that. You might have a fund that's returning 8%, that's invested mostly in land and construction financing versus another fund that's returning 8% that's invested in first mortgages, lower loan to value, existing assets. And they're both generating the same return, and investors don't necessarily know that those are two completely different risk profiles. And
Yeah.
so we spend a lot of time educating. Like, we created an entire video series going over the fundamentals, influencing risk and return. And we also created a mortgage fund investment guide where people can go and read and just get a better idea as to whether they're being well compensated for the risk that they're taking on in whatever fund they're in.
You have a landing page for that? Is that where people would go to get that?
Yeah. People can either come to our website and request that or email us at info@Hawkeye Wealth and send you a link if that would be helpful.
Yeah, absolutely. We'll put it in the show notes. Shifting gears into kind of part two, like the equity deals. Can you walk us through like how that generally looks? And I guess obviously a lot of investors invest with you and then you decide and allocate the funds, or do you present it to investors and they decide which asset they want to invest in? Yeah, just kind of tell us a little bit about that.
Yeah, to date, we have not accepted any funds as Hawkeye Wealth. So investors that want to participate in deals, we bring them the deal. If they like it, they send funds directly to, the third party operator or third party developer, or the mortgage funds have never been held directly by Hawkeye Wealth. That's us. Other firms will operate differently. The principle behind why we've done it that way is I like to keep Hawkeye Wealth as lean as I possibly can while having the high service levels that our clients have come to expect. And the reason for that is we want to be able to afford to say no to a deal. Talked earlier a little bit about the number of equity deals that we did in 2021 versus 22, 23, and 24. We get paid to do equity deals. Comparing the equity deals compared to what the mortgage funds pay us, it's night and day, especially if the deals work well. The mortgage funds pay much less than the equity deals. But we also try and take a long-term perspective where we know if we're pushing an equity deal just for the sake of doing a deal, you do that a few times and just erodes trust, right? So I really tried to build Hawkeye in a way, including our compensation structures and paying commissions, for example. I don't want to have pressure for salespeople begging me for deals to do. It's important to me to be able to afford to say no to a deal.
I love that. How does it work then? So if somebody's going or you're advising them, I guess, to go direct to the developer, what should they look for in terms of like a return on investment? And then I guess do you just kind of advise in the background and
Yeah, we'll facilitate everything. So we'll do subscription agreements. They'll talk to us, not the developer. Like, we're the point of contact, right? That makes us really a one-stop shop, which is really what our clients appreciate. If I walk you through the process of what investing in an equity deal looks like, these are typically entities usually set up as limited partnerships, not always, but usually that entity will invest in the project, such as a development, maybe it's a value add project. Sometimes those entities invest in individual projects. You're investing in this development on Harvey, right? You'll know exactly what you're getting. Sometimes you're investing in a pool of assets. Sometimes you're investing in an idea where they haven't actually bought any of the assets yet, but they outline what the game plan is. Another thing that's important to know is unless you're investing in an open-ended fund, like let's say you're investing in an individual project, there's no public market to trade those investments. These are all private markets. So investors need to make sure that they have a large enough portfolio and liquidity elsewhere in their portfolio to participate. I always like to bring that part up front. I don't like stressing anybody out. If a development deal, if you think it's going to take 2 or 3 years, can it take 4 or 5 years? These are all possibilities, right? So with Hawkeye, almost exclusively do individual projects. So that you'd be investing in a specific development or a specific value add deal. We would do due diligence on that project. We would be speaking with the operator. We'd be looking at a bunch of stuff. I don't know if you want to go into more detail on that, but our investors count on us to be doing the due diligence on both the project and the developer. And then if we like what we see, we bring the most compelling opportunities to our clients. We'd usually send them an email with an information package. The clients would go through the information package, decide whether they like the project and this is something that fits with what they're looking to do. make sure that it's suitable for them. For example, that they have a high enough risk tolerance, that they've got enough liquidity elsewhere in their portfolio. We're required to watch these things and check over these things and make sure it's suitable. That's a regulatory requirement for our firm. Now, we also have to confirm that in most circumstances, at least, that they're an accredited investor. Accredited investors usually qualify by meeting one of the following three criteria. Don't have to meet all three, just one of the three. Over the last 2 years and this year, you've made 200,000 plus in income, or combined with your spouse, 300K plus in income. So that's number one. Or two, you have at least $1 million in what's called net financial assets. These are typically viewed as liquid assets. So this does not count as any of your real estate. If you have equity in real estate, this not a net financial asset. Your cash, your GICs, your stocks, if you have a life insurance policy with a cash surrender value, if you add all those up and you get to over $1 million, that automatically qualifies you as an accredited investor. Or three, if your net worth, so this would include your real estate and all the stocks and bonds and all those other things as well, if that totals over 5 million, that qualifies you as an accredited investor. So this isn't an exhaustive list. There's a number of other things, like you've been registered previously as a financial advisor or a stockbroker, you qualify as registered. There's a number of other ways, but by far those are the three most common.
Okay.
So we'd be making sure that it's suitable for the client. And then as long as that looks good, send you the subscription agreement for signature. Client sends the money to the developer or operator and receives pretty typically quarterly communications and annual tax slips for that investment. So that's the whole process.
What's kind of your threshold? Like, what are you looking for in terms of when you're underwriting these investments? What's kind of your minimum rate of return that you're trying to achieve? Or do you have?
Yeah, so certainly it has to compensate for the risk, right? So we'll start with our mortgage funds, which we view as being more defensively positioned, right? And so you have to be getting a higher return with your development deals than you would with your mortgage funds, right? And so the funds are sort of generating between that, let's call it 7 to 9.5% returns. The development deals are typically, you're looking at a 20+% annualized return is what you want to underwrite it at. Now, I'll tell you guys in this business that you'll almost never find a developer that sends you a pro forma that has underneath a 20% return. But that's really why groups like Hawkeye exist, because not all 20% on pro formas are created equal. You have to look a lot at what inputs have gone into creating that output and what you view as the probability of each of those inputs being true to yield the ultimate output. So you're looking at least those 20% annualized for development deals. Value add projects, you might be willing to take a little bit less, especially if they're not using as much debt. So is it that sort of low to mid teens for the right project? At least pique our interest, because you still have, if things go really well, there's still more potential for upside too, right?
What's the time frame that you're not liquid? I guess like on a development deal, we're talking 5 years.
Yeah. So most of our deals will fall sort of between that 3 to 5 years is target, right? I'd say most of our value add deals are probably somewhere in that same range. Now, sometimes you'll get out before you think. The last couple of years, it's almost never before you think. These last few years, it hasn't made sense. You have a value add asset that you bought in 2021. It's pretty improbable that now would be the best time to sell that asset, even though you had a 3-year business plan, right? So we always want to make sure with clients is that A, they've got a large enough portfolio that they can afford to do a number of deals to get some diversification. In addition to having a large enough portfolio that they can get some diversification, that they've got lots of other money where that came from that's liquid. Because the last thing we need at Hawkeye is to be stressing our clients out because they thought it was going to be a 3-year deal and it ends up being a 6-year deal. These are the risks of going after 20% returns. Like, the idea is you can go and get some higher returns on the private market. The downside is liquidity. So you need to make sure you're the kind of person that doesn't see the illiquidity as a downside, because you just don't need the money.
Right.
So over the last 2+ years, like, the real estate market has been pretty slow. Have you guys had any trouble raising money? Is that any kind of a stop? Like, is that affecting you at all, or is kind of the money always there and you're looking for the projects that pencil, or like, what have you been looking for?
It's definitely become more scarce. I'll put it this way. In 2018, 19, 20, I told you I wake up and I call developers or I call investors. I view this as like I'm sticking a lure out in the water. If I stuck a lure out in the water in 2020, 2021, I'd pull it out and I'd probably bring up an investor half the time. I'd probably bring up way more investors than developers when I put a communication out to the world through social media or wherever.
Yeah.
If I go out and I make a post on LinkedIn, I just did this the other week where I talk about Hawkeye Wealth's business model. Developers fill my boat looking for money. There is a huge scarcity of capital out there.
Interesting.
For us, it's been a tough time and it's been a wonderful time. Why has it been tough? You know, it doesn't matter if you're a great developer or a poor developer, you're subject to the same macroeconomic forces, right? You know, you can execute better, of course, if you're a quality developer, but you're still feeling it right now, no doubt. The upside for Hawkeye is we've been able to establish partnerships with developers that, had we not seen these headwinds with capital raising, we never would have been able to get into the room. The quality of the developers that we're in conversations with, if somebody would have told me 3 years ago that I'd be sitting in each of these developers' head offices like we are now, I wouldn't have believed it. So if there's been one upside, it's the quality of the groups that we're now getting access to deals on. Now, do the deals make sense? That's still important, right? And it's still hard, even with great developers, to find great projects to work with, but we've found a few. Hopefully a few more coming.
When we announce government changes, like, do you ever just throw your hands up in the air? Like, I'm thinking specifically like the capital gains thing. Like, that must have really shooken the boat for you guys. Like, do these other changes also kind of throw you guys for a loop?
Yeah, gonna go smoke meat for a living. So, yeah, it's not the like one change, it's the death by 1,000 cuts.
Yeah, no doubt.
You wake up every day and you just don't know if the game has changed, right? The short-term rentals, you look at what that's done to Kelowna. I think I saw a post the other day that the Fix Cafe was just shutting down, and they cited one of the reasons, you know, lower tourism. I think they might have even said that the short-term rental stuff was part of that cause. And man, I don't know why Kelowna is doing this.
It's amazing because it's not even the province, it's our city that's doing it.
Yeah. I think that might change. I think that pendulum might swing back.
I agree.
I'm hopeful it will. They're starting to realize it a little bit more now that it's a problem, and BC's behind on their housing start goals, which everybody knew they would be, but it's even a little bit farther behind than they thought they would be. That gap between where we are for starts and what our targets are is not going to be narrowing over the next few years. It's going to be widening as the deals don't make sense. And they don't make sense in the vast majority of circumstances. So supply is really going to dwindle over the next few years, and we need to roll back so much of this regulation. It's getting crazy, including on the building code side.
Yeah.
And what that's
I'm surprised
doing.
more people don't bring this up, the building code thing.
Like with accessibility?
Well, just all the things.
That's just one. Yeah. I'm all about accessibility and taking care of the people that have challenges, right? But there's certain ways to go about this, and there's certain ways that are complete wastes of money. I was speaking with a developer. His big comment was, you know, every unit, we're going to have to make these bathrooms huge. Every unit. He's like, Justin, we're going to have a dance floor in the bathroom. And you're thinking, man, you know, oh, it's sad that we don't have housing for families. Well, it would be helpful to have some more space for bedrooms if you didn't have the dance floor in the bathroom, right? And that doesn't mean that you don't need to accommodate folks with mobility issues, you know, on certain floors, or maybe even instead of imposing these restrictions or codes to make 100% of the units accessible, you throw cash at whatever unit somebody with mobility issues wants to move into and just target it more instead of just making these sweeping changes that add inefficiency to the whole process. And ultimately, there's just going to be fewer houses built.
Yeah. And I think that's the main point, right? Like a lot of these sweeping legislation changes are not really thought out long term, right? The cause and effect of it. 100% agree. Like obviously, you know, accessibility has to be thought of, but maybe on a percentage basis of usage of the building.
It's funny because every single person we talk to that knows anything about this says, we need to build more houses. We need to build more houses. And then all these rules that come down basically just target the developer and the people building more houses. It's just like, it doesn't make any sense. Like, it should be easier to put more to market, right? Instead of making it just harder and harder.
I had a friend a little while ago get approval on a large residential rental development. And I heard about it through LinkedIn. There was a news article on it. Hey, this project is going ahead. And everyone was excited. The counselors were talking about how excited they were about it. I forwarded the article to my contact and said, hey, congratulations on getting this city approval. What a milestone. And he literally sends back one sentence, and it said, Justin, the true milestone will be getting the pro forma to work. And I'm like, man, that just encapsulates exactly what's happening in the development space right now. Cities can approve all they want. They're not beyond the laws of math, though. Math is the final arbiter of whether a project proceeds or not, or at least perceived math.
Yeah.
Because a pro forma isn't actuals, they're all projections. And if you feel like your projections are reasonable and it still puts out a decent return that you're okay with, the project proceeds. If it doesn't, it doesn't. And then you've thrown another one on where, okay, 2021, 2, 3, we bring in unprecedented numbers of immigrants. The politicians get word that people aren't so into that and probably aren't going to vote for them if this proceeds. And quite frankly, it was too much.
Yeah.
But the pendulum swings back the other way to where you're like, okay, well, now we're going to have net zero.
Yeah, now we're going to have population decline.
Yeah. And so you're looking at these pro formas. If you're a developer in Kelowna looking at a pro forma, you're having to make assumptions that are going to dictate whether you proceed or not. One of the key assumptions are, what are the current rents in the market and how much are those rents are going to grow by the time that my project delivers. And 2-3 years ago, quite common for you to see, 2.5, 3.5, 4% rent growth built in year by year on these pro formas to get to a number to make the developer say, yeah, let's move forward. What do you use for a number if the taps get turned off on immigration? What do you use? Like, the supply is going to drop off a cliff unless we find some other way. Either A, you believe that your revenues, that the rents are going to go up to justify all of the increased costs that you've had, construction costs, development cost charges, and your amenity cost charges, right? All of these things. Or you have to lower your costs. And then you got to say, okay, well, which part of the stack here is going to get lower? Is labor costs getting lower? No. Plus, we're not even letting people into the country anymore to actually build the stuff, right? So you're starting to look, what gives. And I think that there's a growing portion of the development industry that's pushing back on at least the development charges. Everyone sees that, okay, they can cost as much as 25, 30% of the cost of a development. Let's stop taxing real estate like tobacco, right? I did a post the other day, stop taxing our real estate like our children's Halloween candy. Like,
yeah.
Something's got to give. And I hope that at least a part of the solution is something on the development cost charges, the municipal fees, because, lower interest rates will give some relief, not enough to make these projects go. That's a place where the needle can be moved. And I know the cities can be in a bit of a tough spot too, and I feel for them a little bit, but it's one of those situations where, do you want zero? Because that's what you're going to get if we don't figure this out.
Yeah. Yeah.
Is there any optimism from developers? Like when, you're sitting in these offices and speaking with them, or they're like, hey, you know what, there is actually opportunities in this geographical area or in this asset class, or is it a pretty
a little
dismal...
bit? Like every time you meet up with a developer these days, everyone does the classic, how's it going? And everyone just like takes an extra second to answer the question before they say good. They still say good, but like,
Yeah.
And then you just look at them and you're like, yeah, I get it. We're good too. Like,
you want some meat?
Yeah. Yeah, it kind of feels that way across the whole real estate industry right now. I do think that there is some opportunity, some out there, for us. Where do we possibly see them? Because we're strategy agnostic. Like, we live in Vancouver. We have a lot of relationships in Vancouver, obviously, but we are capital. Capital can go anywhere, right? Developers build up entire teams and sometimes construction companies. And if you're doing that in Vancouver, well, it's hard to go and do that in Texas in 3 months, right? They're just not as mobile. Whereas capital, you can much more easily make those changes. So we've seen a couple of things that have been interesting for the last little while. The last few deals we've done have been situations where developers put the land under contract in 2020 or 2021. They've brought it through the entire entitlement process. So they've rezoned, applied, and sometimes got development and building permits. And so instead of having Hawkeye investors come in 2021 alongside them, we come in 2024, and let's say that there's a 2027 exit. So their investment time horizon from start to finish was 21 to 27. That's 6 years. We're 24 to 27, which is only 3 years, which the returns are just good enough to induce us to go and do the deal. The returns oftentimes for the developers aren't as good as they would be for us, though. These are the sort of things that are getting us off the fence. There's not a lot of those deals. We're getting shown deals nonstop, and it's tough. You're sorting through a lot.
Yeah. I mean, it's kind of a little bit depressing to hear, honestly. Just purely from like, hey, we thought there'd be some motivation to start getting some projects going in the next couple of years.
There might be, like, things can change. Governments can change things for the better too, right? Like, it's not always.
What? No. Yeah. Yet to be seen.
I'm the government and I'm here to help.
Yeah.
Am I speaking to the wrong crowd here?
No,
Come on now. There's a lot of good people with good intent. And if there's something I'm optimistic about, I think the collaboration between the development community and our elected officials, I think, is much higher now because it's necessary. But everyone's going to see, and I think a number are already seeing, the starts. And remember that starts today are projects that started years ago before stuff was even in bad shape, right? If you look at more leading indicators like land transactions and things happening right now, it becomes pretty apparent that we're going to see a lot fewer starts. And so that's a problem for the city. That's a problem for the province. Everybody's in this same boat. And I do have a little bit more optimism that necessity is going to bring everybody together on this. So,
yeah. Well, maybe we can go into some of our wrap up questions too, because speaking about kind of opportunities in markets, if you could buy one property in the Okanagan in the next 12 months, what would it be?
So I lived in the Okanagan from about 2001 to 2008-ish. Did grade 12 in OKM. So I know a little bit about the market here. We haven't done as much research as Hawkeye. We got close on a deal or two, but I haven't done a project there. So I would caution the audience to read too much into what I'm saying. Plus, none of it, of course, is financial advice. If I were looking for myself, though, and I had a decent wad of cash, I always like the idea of buying a single family house in a nice lot in the path of progress. Like, Kelowna is a growing city. I left in 2008. When I go back, and I was just back there for Thanksgiving, I hardly recognize the place.
Yeah.
It is unbelievable what's happened to your town. And I think that trend of folks moving there, I believe it's going to continue. I think the affordability, as people are going to choose where they're going to retire and they're selling in Vancouver, do they do Victoria? Do they do Nanaimo? Do they do Kelowna? I think Kelowna is still going to get its fair share of folks from the lower mainland that think it's a deal. So I always like that. I think that there could be some opportunity in the existing inventory in the pre-sale market, like not stuff that's going to launch over the next, month or two, but stuff that's already launched and just kind of sitting there. And the reasoning for it is, unless the cities dramatically reduce the development cost charges, I don't view it as probable, but it's possible. But assuming that they don't, the costs just aren't coming down. No developer is going to build anything unless there's appreciation in your market. And you guys are probably already seeing this for new condo launches. We're certainly seeing it here in Vancouver. Similar in Kelowna, I take it.
Yeah.
I was just there Thanksgiving weekend, and I went and toured, I think it was the Ascent condos in Upper Mission that High Street was building.
Yeah.
And I was like, man, this is really good bang for your buck. These aren't Vancouver-sized units either. Not like this little 600, 700 square feet, try and cram 2 beds in there. These are like 900 square, like real, spread your arms out units, and for real reasonable prices. I don't think we're going to see those. I really don't. We're just going to see a complete supply crunch. So I think there might be some opportunity in the existing inventory on the pre-sale side that you're not going to see again. If you want a new unit, there's a good chance that now is the time to do it.
Good advice.
I like that development up there for sure.
Yeah, me too.
Yeah, honestly, I've been kind of struggling as an investor trying to find things that pencil out. I like one of your first answers. So single family homes, I think, are going to appreciate in value in Kelowna, primarily due because we just are not building them. The cost to build is too expensive. We are also infilling them. So in addition to that, with CMHC being, insured mortgages up to $1.5 million. So I would pick a single family home between $1 million and $1.5 million. Once that legislation changes goes through, I think there'll be a buyer pool for that when interest rates come down. I would look for a basement suite, or you could convert into a basement suite. There's incentives to do that. And then also a larger lot that you could subdivide. So get 2 tenants in there, go through the subdivision process and sell that land. If I really wanted to get a little bit riskier, I do think what we spoke about before is some of the condos that were short-term rental previously allowed or are being developed to be allowed, I think that could swing back. And I think there are some deals on the market for those.
If you had to bet, and let's take the timeline out, 5 years, are you able to buy a condo and rent it out on Airbnb in Kelowna 5 years from today? And you have to say yes or no. There's no middle ground. What would you guys say?
I say yes.
I say you should be hosting this show. That is a great question.
I definitely say yes to that.
I want to say yes as well, so I will.
With the story being tourism's getting killed, the rental market's already, like, what are we saving here? The rental market's already softening. We've solved the problem. Why are we still killing our economy? Is that kind of the whole rationale, Matt?
Yeah, 5 years, likely a government change. So I would think that true.
Yeah.
Yeah.
I also thought that 5 weeks ago, but here I am wrong.
Well, I didn't think that. I thought we were in for another NDP. Yeah. But in 5 years, I think we're likely not. I think it's going to, that'll change.
I'm grateful for a majority government.
Me too. Me too. Me too. I thought that the Greens really would have thrown a lot of wrenches into the thing. So
Yeah.
I agree totally. Yeah.
So grateful for that. B, what we saw provincially, the Conservatives really gave the NDP a run for their money.
Yeah.
And there were some really key issues that obviously resonated with voters. The NDP, I think that they hopefully have heard some of those concerns and are going to listen and address them. I think what we've seen south of the border, like obviously people are angry. And I think we've got some similar sentiment in Canada towards our current federal government. And I think we're going to see some change. I
would agree with
don't
that.
want to guarantee it, but I view it as highly likely.
If you could give your 20-year-old self any advice, what would it be?
My 20-year-old self, just focus on getting better. Quit worrying so much about what the future holds. Stuff, it has a way of working out. Just quit worrying about it.
All right. What's your favorite charity, or how do you get back?
Yeah, for the past 4 years or so, every year my family has done what's called the Thanksgiving food drive. So we deliver bags in our neighborhood, and we go and collect food, and picked up many thousands of pounds of food over the years, and just hits home. Can't imagine people not having what they need physically to go and make stuff happen. So we're all pretty fortunate here. I don't know. So near and dear to my heart.
I love it.
All right. How can Taylor or I or our listener help you?
Yeah, if anybody wants to talk a little bit about private real estate, whether it be the mortgage funds, or you'd be interested in hearing more about the private equity deals. The private equity deals in particular, we like to get to know the people before we send them out. A lot of the developers are put the private in private equity, right? They don't want their packages sent indiscriminately, so we respect that. And so if that would be of interest, feel free to get in touch. You can come on to our website, or you can email me at justin@hawkeyewealth.com, and I'll happily send you that information. And if you're interested in the mortgage funds, get in touch at the same contact, and make sure you have the link to get access to the mortgage fund guide as well.
Awesome. I love it, man. Well, thank you so much. I appreciated your time and look forward to chatting again soon.
All right. Likewise. Thank you.